All right, we've been showing you stocks and have been volatile. You know what's been a constant? Low rates, low interest rates, low mortgage rates, more to the point. In and out of the 2.10 neck of the woods for a 10-year note. That's been translating into very, very low mortgage rates and a boon for housing. Mortgage applications shooting up 11.3% of the latest period. Now, that could be just a short-lived event, but Jason Meister and Tim Root are looking at the longer-term implications. What do you think, Tim?
Well, I tell you, I mean, the last 20 years you've seen interest rates falling. It seems like God loves a loan officer, but doesn't necessarily love a realtor, because you're seeing that while
God's got very, very good judgment. But go ahead.
Well, what happens is there's actually an inverse relationship between lower rates and consumer confidence and the availability of credit. And that happens because rates are moving up and down for a reason. They move down because basically there's some sort of turmoil. Turmoil doesn't make people very confident to go out and take on the largest purchase of their life, and it doesn't make lenders want to lend. But it certainly makes people want to lower their monthly payments, which triggers refinances.
And obviously, Jason, to take out those applications to do just that. What do you think is going to happen, Jason?
Sure. Neil, for 7 years, we've had a Fed rate at 0. Money's been free. It's got to stop at some point, and I think it's going to happen sooner rather than later. I think we're going to see rates rise this year. I think the Fed will make that move to lift off.
When? Is it going to happen this month?
I think it's probably December now because of the volatility in the market.
And what do you think happens to mortgage rates over which the Fed has no direct control? What happens to them?
Neil, they're going to move at a pace of an injured snail because they cannot raise rates too quickly, too fast.
Tim, what do you think of that? That we might see rates go up courtesy of the Fed, but that might not show up immediately in mortgage and related rates. What do you think?
Yeah, I think Jason's right. I mean, I don't see rates happening going up until December. And, you know, just because the Fed funds rate goes up doesn't mean that long-term interest rates are going to go up. I mean, we see all of the drama in the stock market. I don't think the Fed or anybody else really wants to, you know, rattle investors any further. And there just isn't enough global confidence to drive rates up. So I don't see that being a long-term concern.
But what I'm really concerned about, Neil, is that we've created asset bubbles in some of the major markets like New York City, San Francisco, Miami. This free money has made people, developers, gamble like they're in a casino. And they're buying land at ridiculous prices, and I think that uber luxury market is going to have to come down. There has to be some type of correction. Tim, do you disagree with me?
No, I think that there's always going to be pockets. I mean, real estate is local, but you're certainly seeing some exuberance in certain markets. The bigger concern I think I have, Jason, probably like you, is, you know, the country doesn't really have a stomach for defaults. And the only way you deal with credit bubbles and asset bubbles is either grow your way out, and you can't grow your way out at 2% GDP. You inflate your way out, which we're pretty darn comfortable. But wholesale, we haven't had the appetite.
You don't see anything dramatically altering the universe right now. Gentlemen, I want to thank you both.